You know, there's a company that might already have a spot in your home, and now it wants a spot in your portfolio. I'm talking about Wakefit, that direct-to-consumer brand that's been making waves in the home furnishings world. Well, they're going public. We've gotten our hands on their official IPO document, and we're going to dig right in, look at the numbers, the risks, and try to answer the big question, is this a smart investment? So here's what it all boils down to for us today. Is the Wakefit IPO a solid, foundational investment you can build on for the long haul? Or is it more of a high-risk, high-reward gamble on future growth? Let's get into the details and see what we can figure out.
All right, first things first. Before we even touch the financials, we have to understand the story. Who is Wakefit really? And what's their secret sauce? How are they trying to win in such a packed market?
Wakefit's whole game plan is built around what they call a full stock model. Basically, they control the entire journey. They design their own products, they make them in their own factories, and they sell them straight to you online. The big idea here is that by cutting out all the middlemen, the distributors, the retail stores, they can keep a tight grip on quality, react to new trends way faster, and, in theory, make better profits. It's a huge bet on controlling the entire experience, from start to finish.
Now, they definitely got famous for their mattresses, but take a look at this chart. It shows you their ambition is so much bigger. They've made a huge push into furniture. We're talking beds, sofas, the whole 9 yards, and all sorts of other home goods. This isn't just about adding new products, it's central to their goal of becoming a one-stop shop for your home. They don't just want to sell you a mattress, they want to furnish your entire bedroom. And this is just a perfect example of how they think. See, they're not just a furniture company. They're obsessed with technology and efficiency. By figuring out how to compress and roll pack their mattresses into a box, they absolutely slashed their shipping and storage costs. It made selling something so bulky online suddenly way more practical. It's a classic move, using a clever process to get a leg up on the competition.
Okay, so the story sounds compelling, right? But you know what really matters in the end? Does it actually translate into financial success? Let's pull up their track record and see what the numbers say.
Well, when it comes to growth, the story is definitely strong. I mean, just look at this chart. This is data taken straight from their prospectus, and it shows a really clear, impressive climb in revenue. Year after year, they've sold more stuff and pushed that top line higher and higher. This is exactly the kind of thing that growth investors love to see.
But, and this is a big but, here's the catch. All of that amazing growth didn't come for free. This is a direct quote from their own IPO document, and they're being incredibly blunt about it. They've been spending a ton of money to get new customers and build out their operations, which means they haven't actually made a profit yet. It's that classic dilemma. Do you want growth or do you want profitability? Right now, they're all in on growth.
So, you can't really size up an investment without looking at the dark side. You have to understand the risks. And, to Wakefit's credit, they're pretty open about the challenges they're up against. Let's take a look at some of that fine print.
Here are some of the big operational hurdles they've pointed out. First, their supply chain is a bit vulnerable. They don't have long-term deals with their raw material suppliers, so prices could spike. They also rely on other companies for their deliveries, and you know how it is today, a few viral, negative reviews on social media could really hurt their brand. And on top of all that, let's not forget, the furniture market is just incredibly competitive.
And the risks aren't just about operations. They also get into some tricky legal territory. This quote, for instance, is from a dispute they had with a competitor over who gets to use the word orthopedic. It's just a great reminder that even the words they use in their marketing can become a battleground and a potential legal headache down the road.
Okay, so why go public right now? At the end of the day, an IPO is about one thing: raising cash. The really important question for us as potential investors is, where is all that money going to go?
Their plan is actually pretty simple. They're doubling down on what they do best. A huge chunk of the money from the IPO is going right back into their factories. They're buying specific, high-tech equipment, things like automatic beam saws and CNC routers. The goal is pretty clear: make more stuff and make it more efficiently to fuel that next wave of growth. And that brings us to the final and maybe the most important piece of this entire puzzle. We've looked at the story, the performance, the risks, but for anyone thinking about investing, it all comes down to this one question: is the price of this IPO actually fair? To figure that out, we need a standard tool that investors use called the price-to-earnings, or PE ratio. The simple way to think about it is this: it tells you how much investors are willing to pay for every single dollar the company earns. A really high PE usually means investors are expecting big growth in the future.
And wow, this table really puts everything into perspective. See, since Wakefit isn't making a profit, its PE ratio is NA.
You can't have a price-to-earnings ratio if there are no earnings. Now look at their publicly traded competitor, Sheila Foam. It's trading at a super high PE of over 77. Then there's return on net worth, basically how well a company is using shareholder money to make a profit. Wakefit's is negative, Sheila Foam's is positive. This tells you investors and their rival are getting a return, while Wakefit is still in that heavy investment phase, burning cash to get bigger.
So, really, you're left with two completely different ways to look at this. The bull case, the optimistic view, is that you're getting in early on a true D2C disruptor, a company with incredible growth in a massive market. The bear case, the skeptical view, is that you're betting on a company that hasn't made any money yet, faces some pretty serious risks, and just doesn't have the earnings to justify a high price. Well, at least not yet.
So, when all is said and done, the decision really comes down to this. Do you believe that Wakefit's incredible growth story is powerful enough to overcome its history of losses and all the challenges of a really tough market? Is the potential reward here actually worth the very real risks? That's the question you've got to answer.